This week we are coming out with two interesting webinars, and the first webinar is what should you do when the market goes nowhere? The investment strategies that work. And the second webinar is women's only webinar, that is Kodishwari webinar, investing between market chaos, where we discuss on how to navigate through market hurdles for your investment journey. To join the webinar, click the link in the description.
As investors, we may define risk very differently. But the one thing that all of us can agree on is that risk needs to be managed effectively. When we start effectively managing risk, the results are quite spectacular. So in today's video, we're going to discuss 5 effective strategies for you to manage portfolio risk. The first and obvious risk management tool is diversification. Whether you're a pure equity investor or somebody who's a multi-asset investor, you tend to diversify so that you reduce concentration risk. This means deciding how many stocks you want to own within a portfolio, or how many funds across how many categories, or within your stock universe, how many sectors you're exposed to. All of this ensures that we're not putting all of our eggs in one basket, and diversification helps spread that risk around. The basic idea with diversification is that you're going to have investments in different places that actually perform in different manners, and that can prepare your portfolio for a wider range of scenarios where it's going to work well for you. The second risk management tool is participation. Now, a lot of us don't really think that we can contribute too much, because we tend to view risk as something external which happens to our portfolio in terms of how you see drawdowns or a market correction which affects the value of your investments. Now, when we start taking a more proactive role in risk management, what we realize is how we contribute, when we contribute, matters a lot. And that can be an effective risk management tool. So an investor can plan contributions either systematically. So if you're a mutual fund investor, an SIP is a great way to ensure that you're participating at every level of the market. If you're not a mutual fund investor, or you want to manage investments in a different way, then you can look at keeping some dry powder handy whenever you see risk levels in markets fluctuate. The third effective risk management tool is value investing. Now, when you're value conscious, you're actually thinking about how much a particular business or asset is worth before you participate in it. And if you're paying a fair price, it's unlikely that you have too much to experience on the downside. Whereas if you're also looking at exits, then you know that when your asset is outside the valuation comfort zone, then you're booking profits and making sure that you don't experience too much downside from that point. So when you're value conscious, what tends to happen is you're very disciplined in your buying and your selling, and this essentially tilts the odds in your favor. So it's a really smart way of being a good investor. The fourth tool that we're looking at is position sizing. We've talked a lot about position sizing on this channel, and it matters simply because position determines how much exposure you have to a particular idea, how much risk you're exposed to, as well as how much rewards you can potentially reap. So the idea of maintaining the right position or profit booking when your position gets much larger than you expect actually helps you manage risk effectively. At the same time, if you have high conviction, a clear position sizing strategy will tell you that you need to either scale up or maintain this. Now, over a period of time, as your portfolio value changes, your position sizes are also going to change. And this is when investors need to come back and review these position sizes and see whether they're working or if they need some tweaking to be done. Last but not least, we have quality as a risk management tool. For a serious investor, paying attention to quality and paying for quality actually is going to give you much better peace of mind and a more smoother investment journey. You don't have to worry about the ups and downs if you're paying for a robust business, or if you're actually looking at high quality management which are good at executing business strategies. At the end of the day, as an equity investor, what you own is a business. So what matters is how the business will do, and we always know in the real world as well that quality never fails. So why not take this simple lesson from the real world into our investing? If we're willing to pay for quality in the things that we buy, why not in the assets that we're trying to create wealth with? I hope these 5 strategies have given you a smarter way to manage risk in your portfolio. If you have another type of risk management tool handy, then let us know how you are handling risk in the comments below.